Okay, good afternoon. Welcome back, everyone, to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a topic that I think is quite timely to the market that we are currently experiencing: a bit of volatility, some potential downside to the equity markets as interest rates continue to rise, as risks in the fixed income markets continue to bubble. I think there's a lot of uncertainty and potentially needs to protect your portfolio, whether you're fully invested, whether you are moving some investments into cash. There are different strategies for protecting your portfolio. So today we want to go through what those strategies are. And I actually want to spend quite a bit of time today going through the, looks like there's some, 1 second. Huh. Okay, is that audio a little better? Hopefully you guys can now hear me better. Okay, I apologize for that. Let's get back to it. So, like I said, today we're here to talk about a practical approach to hedging your portfolio. I'm going to spend less time today on the slides. I want to spend more time on the platform, walking you through real examples of potentially protecting your portfolio in the current market environment that we are in. So let's go ahead and get started. Before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss here today. I'm just having issues all around with my computer. Okay, so we'll start off by just taking a look at the broader market outlook. There's been some changes in terms of the equity markets. We've been talking about this uptrend in the equity markets. That uptrend has clearly been broken. So some of the key levels that we want to take a look at to understand how do we expect equity markets to respond going forward, especially after today's session. I think it's pretty clear that there could be some further downside. So walking through those levels, talking a little bit about portfolio strategies in a recession, portfolio hedging strategy using options, and kind of the stages of a market correction. I'm not going to spend so much time today on the stages of market correction because we're in the midst of a market correction. I think I want to spend more time talking about optimal portfolio hedges. I think that's a better use of our time for today. So the primary thing that I want to help everyone who's viewing this webinar here today is a clear understanding when you finish today as to how can you efficiently hedge your portfolio against a major market correction. So before I jump into this, I'm curious, how many of you that are viewing here today are concerned about further downside in the equity markets? Please type 1 into the chat window if you are. Please type 2 into the chat window if you do not believe that we're due for further downside and it's time to simply buy this dip. Okay, so I would say, normally when I do these sessions, there tends to be quite a bit of concern, but usually there's a lot of people that are saying, no, it's time to buy the dip. This is one of the times where I've seen very few people say it's time to buy the dips. And one of the things that I do think is important to pay attention to is this uptrend that we've been talking about in the S&P 500 that's been in place for a very long time. And this uptrend has recently been broken to the downside. And just yesterday, we managed to rally all the way back up, almost a 10% rally back to that trend line. And just today, what we've confirmed is a rejection at that trend line. So what this leads me to believe is that at least on the S&P, my expectation is that we're likely going to revisit 430 If we break below 430, that's going to be a bit of a concern here for equities, because 430 is a major support level that has held for multiple pullbacks here. If we break below that level, then we're really looking at closer to the levels back here, just above 400, just shy of 400 or so to the downside. So this is really where we can start to see some further volatility going forward. And another way to look at this market here as well is this is a zoomed in chart of the S&P 500. Our recent high was around 480. We declined from 480 all the way down to 420. That's a 60-point move in the SPY. And what we've had is a rally of about 37 points, which is about 618% of the fib retracement level. So we've managed to get all the way back to the 618 yesterday, and we've seen a rejection. This is further evidence for me that we could be headed back down to at least 430 and potentially 420 here to the downside on the S&P. And what we've seen here before also, when we look at the previous slide here, what you do have is momentum has turned negative, and this is as long as the momentum indicator has been negative on the S&P chart for quite some time. You have negative momentum on the daily chart, and what we saw was as we pushed towards these higher highs around 480, we started to see divergence here with momentum. And then, so let's talk a little bit about how to go about hedging a portfolio. So when we talk about a portfolio hedge, the easiest way to think about this is really think of a portfolio hedge as kind of like an insurance policy on your portfolio. And what we're doing here is we're buying a put option on a broad-based index, either an ETF or an index. And what we're trying to do is the profits from that ETF, the profits from the puts, if the market corrects, will offset any losses that we have on the portfolio. And this portfolio hedge will create what we call an imperfect partial hedge. And the reason that we call this an imperfect partial hedge is because if the market declines, you're not going to see dollar for dollar return on your hedge. So unlike an insurance policy that might pay out 100% of the losses, when you buy a put option, you're not going to get all of that protection. And it's important to understand, and probably the most important thing to understand, is that it's extremely expensive. We'll talk a little bit about this as to how expensive it is, but because of how expensive it is, it requires active management and timing. It's not something like you can just buy an insurance policy and have all the time. You really have to be cognizant of how much it costs and really only buy insurance when you think you need it. And sometimes you basically are buying insurance when your house is already on fire. And usually when you buy insurance when your house is already on fire, it's expensive. So that's kind of the best way to think about that. Does that make sense? Please type 2 into the chat window if that makes sense to you. Perfect. So a portfolio hedge is simple in concept. You have a stock portfolio that makes profits if the markets go higher, that sees losses if the markets declines in value. And what we're doing is we're adding to this portfolio a put option. A put option makes profits as the market declines. And the benefit of the put option is that the losses on the put option is capped, meaning what you pay for a put option, that's the most you can lose. And this really gives a risk profile when you add the two together that looks similar to a call option, meaning it still gives you upside. So if the market continues to move higher, you still have further potential opportunities to make profits. But if the market declines, you limit your losses here to the downside. Now, this is not to scale. In reality, your portfolio will probably look something more like this, meaning there will be still some losses, but just not as steep as if you were unhedged in that portfolio. Does that make sense? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so when we look at a hedging instrument, let's look at picking an instrument for this. Usually when we talk about a hedging instrument, we usually talk about some type of broad-based index or ETF. And you really have the choice between the two. And first thing what you want to do is you want to first pick an ETF or index that mimics your portfolio. So if you have a broad-based portfolio, meaning you have a lot of different stocks in a lot of different sectors, some small cap, some large cap, then using a broad-based index like the Nasdaq, the S&P 500, the Nasdaq 100, generally speaking, are suitable. If you have a very focused portfolio of, let's say, you have a lot of real estate or a lot of energy stocks, then you want to just find an index or an ETF that closely mimics your portfolio, which is, usually we have a pretty good sense of what our portfolio is consist of, whether it's just a few stocks and very concentrated in a specific sector or asset class, or you have a very broad-based portfolio. But the goal is to pick an ETF or index that mimics your portfolio, because as the index declines, you want to be able to profit from that. So when we talk about hedging your portfolio using a put option, you really have two choices. You can either use ETF options or you can use index options. Now, ETF options are going to give you a much broader coverage of portfolios, meaning there are 2,000 ETFs or so. So I would imagine that no matter what your portfolio consists of, there's an ETF out there that you can find that mimics your portfolio somewhat closely. Index options, there's not that many. There's only about 40 index options available for trading. In terms of the major indices, there are just a few. There are really just a handful. So it's really, index options are only useful if you have a broad-based portfolio. They're not really useful if you have a very focused portfolio. But index options do provide cash settlement. So you don't have to necessarily exit the trade at expiration. Your profits from the hedge or losses from the hedge are just simply debited or credited from your account. You do have favorable tax treatment if you're trading in a taxable account. So, especially these hedges, they tend to be short term, meaning you're not holding onto a hedge for more than a year. So you're typically paying short-term capital gains if you're in a taxable account. Index option gives you 60-40, 60% long-term, 40% short-term. So you can potentially get a little bit more efficiency in terms of tax structuring with an index option. So if you're using, let's say, the S&P 500, using an S&P 500 index option versus an S&P 500 ETF option, you're going to get a little benefit potentially from the tax treatment if you're trading in a taxable account. So it's important to pick not only the right index, but also whether you're choosing between ETFs and options. So those are your kind of two choices when it comes to these types of options. So what I want to spend most of our time talking through are real cases and real examples of hedging your portfolio. So, when we talk about hedging small pullbacks, what we've seen in the markets over the past few weeks, that's what I would consider a bit of a smaller pullback, something in the 3, 5, 7% range, right? And then when you're talking about larger pullbacks, this is really when you're thinking that the markets are going to correct more than 5 to 10%. So depending on what your views are in the markets, if you're just concerned about some short-term volatility that might last a few weeks and you're going to get out, then usually when you're hedging, you want to use shorter dated options, because those shorter dated options are going to help you maximize gamma. So as the market declines, the delta of the option is going to accelerate at a faster rate, giving you more protection. It actually increases the amount of protection you get the further the market declines. Versus when you're expecting a long-term pullback, a larger pullback here, you generally want to use longer dated options because you want to minimize time decay. With the longer pullback, you might be in that trade for a month or 2 months. You want to make sure that during the time period that you're holding on to that trade, you're paying relatively small amounts of time decay per day. And the way to minimize that is by buying a longer dated option. So expiration dates is going to be sensitive to how big of a pullback you're expecting in the markets. Does that make sense? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so talking a little bit about strategy then. So just like, when we think about insurance, you get the choice of how much insurance do you want to purchase? Well, when you're selecting strike prices, when you're selecting strategies, it's kind of like picking what kind of insurance do you want. You can buy catastrophic insurance, you could buy comprehensive insurance, And you can buy what I call, let's call it limited insurance. It doesn't really exist in the real world, but in the world of options, it does, right? So these are your three choices when it comes to buying protection on your portfolio. We're going to go through all three today so that you can see the difference and understand which one's best suited for you. Catastrophic insurance, as you know, it only pays out if there's a major downside correction. This is when you're buying an out of the money put option. Something in the 30 to 40 delta range is usually a good starting point. These are going to be cheap, just like buying catastrophic insurance is cheap. It's only going to cost you somewhere in the neighborhood of 1 to 3% of your total portfolio value to buy that downside protection. This is usually over a 1 to 2 month time frame. 1 to 3% over a 1 to 2 month time frame is not cheap, but relative to other insurance is relatively inexpensive. You can also buy catastrophic insurance, which provides any downside correction. So it'll provide protection in every possible scenario. So even think about like a small scratch on your car. It's going to provide that comprehensive insurance. It's going to prevent losses even in a small decline in the broader markets. For this, you want to buy in the money puts. About a 50 to 60 delta is a good starting point. This is going to be more expensive. It's going to cost you about 3 to 5% of your total portfolio value. And we're going to show you some examples of that. And then lastly, this only exists in the options world, doesn't exist in the real world, where you buy a limited protection, where you're protecting yourself only for a certain amount of downside correction. And this is really where, when you expect that the markets are going to correct down to a certain point, but you don't expect the markets to go beyond that. And this can provide some interesting benefits in the form of really inexpensive portfolio hedging costs in exchange for limited downside protection. And this is really where you're going to buy an in the money put, the same put as you would normally do here when you're buying comprehensive insurance, but then you're going to also sell an out of the money put option based on the downside target that you have. So if you believe the markets are going to correct from 480 down to 420, you can buy protection just from 480 to 420 and basically waive your protection below 420, if that sort of makes sense. It's almost like buying insurance for this part and then selling insurance for that part is effectively what you're doing when you're buying a put spread. And we're going to explore that as well. We're going to compare all three and just kind of show you the difference between the three strategies. But does that make sense? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so I'll come back to talk a little bit about capitulation and market bottoms from a timing perspective. I think that what I want to do is probably best just to jump right into kind of where we currently sit in the S&P 500, the Qs, and taking a look at where we are. You know, we were down about 4% here today on the NASDAQ 100, getting rejected at that at this level here around 370 or so, and now we're back down to about 353. So what I want to explore is how to hedge your portfolio against some further downside. We're going to use OptionsPlay to do so. And what I'm going to do here is I'm going to first set up one strategy here on the left-hand side. And I'm going to use this strategy as a proxy for your portfolio. And then what we're going to do is we're going to use two different strategies. We're going to look at buying an in-the-money put option, and then we're also going to look at buying an out of the money put option. We're going to look at both. So you know, market's around 353 right now, so I'll look at a 345 and a 360 put. A put option that's about $7 in the money and a put option that's about $8 out of the money, roughly or speaking. So, you know, roughly equal amount in the money versus out of the money. And in order to really compare your portfolio against two different hedges, right? What I want to do is I want to first create a more realistic portfolio. So what I'm going to use is the risk and investment calculator. I'm going to type in a portfolio amount. So let's say I have a $100,000 portfolio. I'm going to use an even number to make this easy to understand. So let's say I have a $100,000 portfolio. That's the equivalent of 277 shares of the Qs. As you can see, that will cost me about $100,000 to buy 277 shares of the Qs. Now, to hedge a 277 share portfolio in the Qs, I need to buy 3 contracts of each put option to hedge a portfolio that's nearly 300 shares of the Qs. So for my $100,000 portfolio, the comprehensive insurance costs $5,000. The catastrophic insurance costs $3,300. So one costs 5%, one costs 3.3%. This is the difference in terms of price between the comprehensive and catastrophic insurance. And in order to understand this, what we are going to use is the P&L simulator. And we're going to simulate what happens if the Qs decline back towards the lower end of the range, or if it starts to break further below that range. What should our expectations be with our portfolio, and what should our expectations be with the hedge itself? So let's first start off by assuming for 1 second that the market doesn't move at all. Let's say a month later, maybe the market declines a little, maybe it goes back up a little, and a month later, it ends up at exactly the same price that we entered the hedge at, right? If we did that, if we end up at exactly that same price, our portfolio and the Qs have moved after hours here, which is why this number here still looks a little different here at the moment. But largely what we should expect is our portfolio will largely be flat. Looks like the Qs have moved up a little bit after hours, almost 2% after hours. I think it's probably because of Amazon's earnings. Amazon is up quite a bit after hours. But what we should see is that our portfolio would be roughly flat if the markets do not move. But what you're going to see here is that if you had bought the comprehensive insurance, you would lose an additional $2,700. Now, this is because the insurance didn't really kick in. That's not really useful. So you're going to lose some of the premium that you pay, just like an insurance premium that you pay. If you pay the premiums, whether you utilize that insurance or not. And if you don't utilize an insurance, the premiums that you paid is lost. So that's effectively the same thing that you have here in the catastrophic insurance. Some of the premium that you pay is lost. But what you notice here is that you lose $2,700. But if you look at the catastrophic insurance, you actually lose more. You actually lose $3,300. So even though the comprehensive insurance is more expensive, when you don't need it, you actually end up losing a little bit less. And that's because you bought an in-the-money put option. Not all of it is extrinsic value. So a lot of it has intrinsic value. Even if the markets don't move, that intrinsic value does not lose value. Only the extrinsic more in extrinsic value when you buy the catastrophic insurance than when you buy the comprehensive insurance. So for that reason, when the markets don't move, the catastrophic insurance will actually be worse for you, even though it was cheaper. Does that make sense? Please type 6 into the chat window if that makes sense to you. It's a little counterintuitive, and it's a little counter to kind of what you might experience with buying an actual insurance policy, but this hopefully helped illustrate the difference between the two. Now, let's take a look at what happens if the market starts to decline a little. Let's say the market starts declining back to that 336 level or so, 336. Now, as you can see, I've lost a total of about 6% in my portfolio, $6,800 in my portfolio. Now, and what you're going to see here is that the comprehensive insurance makes back about $4,200. So I'm making back $4,200 out of the $6,800 that I've lost. The reality here is actually only about $4,800 because the Qs are up about 2% or almost $2,000 after hours here. So this number is actually somewhat inaccurate because the markets have already moved up 2% after hours. So what I would have done is I would have lost $4,800 and I would have made $2,400 back. So I've made more than 50% of what I've lost back with the comprehensive insurance. But at this point, the catastrophic insurance, as you can see, even though I've lost about $4,800 in my portfolio, I'm going to lose an additional $600 in my catastrophic insurance because, again, catastrophic insurance only pays out when there's a catastrophe. And when the markets correct from 353 to 336, unfortunately, that's not a large enough of a catastrophe for the catastrophic insurance to pay out. So you basically are losing even more premium, right? This is the part I think that hurts the most when you buy catastrophic insurance is that, you have a loss, but you're not covered, right? And it's because you bought the cheaper insurance. You said, I don't want to pay the extra $2,000. Well, now you're down an additional $600, kind of, to go after that. So, you get what you pay for, if you will, right? And this is what you get when you buy cheap insurance. So I hope that makes sense to everyone. Please type 7 into the chat window if that makes sense to you. Perfect. Okay, so now let's look at what happens if the market really starts to seriously decline. Let's say it goes below that 336 level, right? So looking back on the Qs, let's say it gets back down to the 307 or so, which is the major support level back here in very early 2021. What did I say, 307? Let's look at 307. Okay, now the market declines to 307. I've lost close to 15 grand on my portfolio. Like I said, because of after hours, that number is really close to about 13 grand, right? So if the market declines about 15%, I'm looking at about 15 grand that I've lost. I'm going to make back out of the 15 grand that I lost $11,000 or so with my comprehensive insurance. And what you're going to see is that no matter how far the market declines, the comprehensive insurance will always cover me, with the exception of about $4,000 or so. The distance between these two numbers are about $4,000. Even if the market goes down to zero, I'm only going to have about $4,000 loss more from the portfolio than what I gained back from the comprehensive insurance. Now, the catastrophic insurance at this point does start to pay out, because at this point, when the market declines to 307, that is considered a catastrophe, because you bought a 343 put. We're now well below that 345 put at 307. That's going to start providing some profit. So if you lost 15 grand in the portfolio, you're going to make about half of that back, 8 grand back from the catastrophic insurance. So as you can see here, what you're getting is what you're paying for. The more expensive your options, the insurance that you're receiving or that you're paying for, the better the protection you get. The cheaper the insurance that you pay, or the cheaper the puts that you pay, the less protection that you're really getting, or at least a smaller amount of protection that you're getting. So, this is really hopefully highlights to you, when you're looking for a put option to buy on your portfolio, what should you be looking for? Now, at the end of the day, I don't necessarily know that one is better than the other. It really just depends on how much coverage do you need and what your views are in the markets. If you think that the markets are going to drop significantly, you can do other things as well. You can buy more contracts of the cheaper insurance, right? Roughly same amount of capital, $5,000 or so. And if the market does make a big decline, you can actually get paid more for the profits using the catastrophic insurance with more contracts with the same amount of premium. So you have some choices here. I'm not saying that the catastrophic insurance is bad. It's just that when you look at it dollar for dollar, you're just not getting much protection. And I think in many scenarios, you actually come out worse buying catastrophic insurance than you buy comprehensive insurance. So the extra, in this particular case, $1,700, in my opinion, is worth it when you're really concerned about protecting your portfolio. Does that make sense? Please type 8 into the chat window if that makes sense to you. Perfect. So lastly, what I want to do is I want to explore buying a put spread. And this is really where you can be very tactical about where you think the markets are going. Let's say you think the market's going to correct down to 315 or so. So what you buy is an at the money put option, or maybe a slightly in the money put option, like a 360, 315. Remember how we said you want to buy the in the money option, and then you want to sell an out of the money option at the target price that you think the markets will correct to. In this particular case, let's say you think the markets can get down as far as 315 or so. These are the lows from May of 2021. You're concerned that the markets will correct all the way down here. Well, look at this. To buy a single contract only costs you $1,168. That's about a third of the price of the catastrophic insurance. So this is being very tactical, and there are some trade-offs with it, But as you can see, what you can see is some significant profits if it gets down to roughly the level that you're expecting to, which is around 315 or so, right? So let's say the market trades down to about 315. As you can see here, you're getting 3,300 and, oh, this is for one contract. I apologize. Let's change this to 3 contracts so that we're comparing apples to apples. As you can see here, if I bought 3 contracts of this, right, the same cost, effectively the same cost as the catastrophic insurance, but if the market declines down to 315, I'm looking at about almost $10,000 in coverage versus even the comprehensive insurance doesn't provide that much coverage of only 8,700, and the catastrophic insurance doesn't come anywhere close. So for the same cost as the catastrophic insurance, I can be tactical and use put spread that can actually give me more protection than even the comprehensive insurance for the same cost of the catastrophic insurance. Now, again, like I said, there are some trade-offs with this. And the major trade-off is that if you're wrong and the market does correct further, well, you've now limited the protection that you get. You only get, in this particular case, $10,000 worth of protection. If the market goes down to 200, you're still only getting $10,000 worth of protection. So it comes at a lower cost. It's far more effective in the short run, but if you get the magnitude wrong and the market's really correct to the downside, that's really where the put spread underperform. Does that make sense? Please type 9 into the chat window if that makes sense to you. Now, even though that is the case, I will say most of the time when it comes to buying insurance, I will most likely revert to a strategy like this. Because normally, most of the times, when we're looking at buying some protection, I'm usually not concerned about the market hitting 0. And also, if the market does start to move back down to the levels down here to around 315 or so, and at that point, I'm concerned that the markets can continue to go. What I can do is I can take profits, I can take my $10,000 profit, and what I can do is I can buy a new put spread. I can buy maybe a 315, 260 put spread, and I can buy more put spreads for roughly the same cost and still continue to buy my protection here to the downside. So whenever we're, we kind of have all heard some, the reason that Warren Buffett buys insurance companies because he likes to collect premiums, right? Well, when you're thinking about buying insurance, yes, you want to buy insurance because what you need it, but if you ever have the opportunity to sell insurance and collect premium, that's always going to be a potentially worthwhile outcome. And that's really exactly how you can think about a put spread, is you're buying protection down to a certain level or from a certain level down to a certain level. And then what you're doing is you're waiving the rest of the protection by selling someone else the insurance below that level. So that what you're doing is you're only really buying the protection down here, but you're doing it at a cost that's very effective, close to the same cost as buying catastrophic insurance, but getting arguably even better coverage than comprehensive insurance. So that's really the way that I think you should think about buying these puts and put spreads on your portfolio. Right now, with the amount of volatility we've seen in the markets, this is the time to consider using this, especially if you miss buying protection on this pullback. We've now pulled back 61% of that move. So if you're expecting further downside, this is, in my opinion, to re-enter some put hedges here to the downside if you are concerned about further downside, which based on our initial conversation, it seems like a vast majority of you on the session here today is concerned about some further downside here in equities. So hopefully this illustrates to you how you can use OptionsPlay, and you can replace QQQ with any other ETF or index option that suits your portfolio. We can look at XND, which is the NASDAQ 100 index option as well. You can use these. These are more tax efficient if you are trading in a taxable account, and they are cash settled. So you don't have to worry about closing out a spread at expiration or having to sell the put option that you've purchased. You can simply hold them to expiration and they're settled in cash. Or if, let's say, you have a very sector-focused portfolio, let's say you have a lot of banks in your portfolio. Well, if you want to hedge bank or financial focused portfolio, you can use one of the sector ETF, US XLF, which is the financials ETF. And what you can do is you can always use this panel as the proxy for your portfolio, and then you can use 2 put options to set up side by side. Once you set that up, I always encourage you, when you have different strike prices, to use the risk and investment calculator. Put in your actual portfolio. So if you have a $250,000 portfolio, put that in, because that will then mimic your portfolio here and the number of contracts that you need in order to buy a put. So if you have a $2,300, let's say $250,000 portfolio, let's make this a little less crazy. So if you have a $250,000 portfolio, the catastrophic insurance will cost you about $7,500. The comprehensive insurance will cost you about 12 grand. And then you can also look at buying a put and sell those, compare with each other. So if you're only concerned about some downside protection, 63 contracts of each is only $9,000. So somewhere in between these two numbers, a little more catastrophic insurance. But like I said, if the markets do decline, as you can see, this will pay out similar rates to the comprehensive insurance, even better rates than the comprehensive insurance, for a cost that is much more comparable to the catastrophic insurance. So this is really kind of where you should be utilizing OptionsPlay to test out these different scenarios. Again, one is not better than the other. I do think that many times I will tend to use the spread, but it's important to just understand the different options that you have and explore them all before you execute any of these strategies in your portfolio. So with that, what I will do is I will spend 2 minutes in talking a little bit about market timing. And this really comes to the question, right now we've spent a lot of time talking about entering a hedge. I also get a lot of questions regarding, when do you exit a hedge? And this is a bit of an art and also at the same time, some science involved here. But usually what we see here when we see major market corrections is that before the market actually bottoms, what we typically see is volatility will have peaked before the actual market bottom. What that means, and this is the sell-off from the coronavirus, this was roughly 1 month long in terms of a very quick and violent sell-off that we saw in the broader markets. And what you see here is that this is where the market bottomed, but a full 1, 2, 3, 4, I believe 5 days before the market bottom, the VIX actually peaked. So you actually had quite a few days of the VIX declining while the market declined. And that usually is a pretty good sign that we are near a market bottom, meaning the volatility of volatility has declined before the market bottoms. Rarely does a market bottom with the same time that the volatility peaks. And this is usually for major market corrections. So when you start to see markets continue to move lower and VIX is also at the same time also moving lower, that's usually a sign that perhaps it's time to start thinking about lightening up the hedge position that you have. Many times you can also see momentum start to see positive divergence. What that means is that price continues to move lower, but the momentum indicators that you're looking at is actually starting to move higher here. It's similar concept in terms of the fact that the volatility of the change is starting to slow down. That's a sign that we're near a market bottom. Or for those of you that did join me on Tuesday, you saw Rick show you some of our DeMark studies. That's also another way to measure market exhaustion. The DeMark sequential indicators are a way to measure market tops and market bottoms, and also another way that you could potentially time when to exit and exit. When to enter and exit a specific hedge. So that kind of just gives you an overview of kind of when to also exit a trade. So a few things to remember. One, this is really one of the few examples, in my opinion, where it's better to be late than early. What I mean by that is that only hedge when you're actually bearish on the markets. I cannot tell you enough how many times people anticipate a potential pullback, because 9 out of 10 times, and the math and the statistics behind this hold up, where basically 9 out of 10 times when you're concerned about a pullback, it doesn't materialize. So imagine buying insurance 9 out of 10 times when you're not going to need it. Well, you're going to end up paying a lot of premium for protection that you don't really ultimately need. So it's better to buy protection when your house is already on fire. It's going to be more expensive, but it's not going to be 10 times as expensive. But if you try to hedge every single time the market is at near a top, 9 out of 10 times the markets won't correct and you're not going to need that insurance. So that's why it's better to be late than early. You can also sell cover calls and credit spreads as soon as you find yourself longer bullish on the markets, because markets can remain not bullish for quite some time before they actually decline. We've seen the markets kind of move sideways for months now before we've actually started to see the actual decline. That was an opportunity to sell call options. That was an opportunity to sell credit spreads, because the premium that you collect from that, you can use to buy the put options that we're talking about here during today's session. In the money puts will provide better overall protection. Out of the money options will provide better catastrophic protection in your portfolio. So with that covers what I wanted to share with you here today. I hope that today not only gives you kind of a different way of thinking about buying protection on your portfolio, but hopefully today gives you an illustration as how to use the OptionsPlay platform to actually set these up, explore them, understand the cost, and understand the protection that you're actually getting before you place a real trade in your portfolio. With that, what I'll do is I'll open this up for Q&A. If anyone has any questions regarding hedging or the examples that I gave here today, please type your questions into the Q&A section, and I'll try to answer as many questions as I have time for here before I jump off for today. So questions in the Q&A section, I'll try to answer as many questions as possible. The meaning of 66, 127, 97 on the strategy section. Oh, the question is the OptionsPlay score. The OptionsPlay score is a probability weighted risk reward ratio. The reason we created that is because the risk reward ratio on these three strategies, if you look at them, really mean nothing, and it's hard to determine that. One has a max reward of $231,000, and this one has $239,000, but this one has $16,000. You have different risks, you have different probability of profits. So there's a lot of numbers to digest here, and it's hard to understand which one's better. And that's why we created the OptionsPlay score, to give you that risk, probability weighted risk to reward ratio, so that you have a clear sense for which one of these strategies has better or higher expected outcome if the markets were fairly efficient. How does buying a put option for protection compare to short selling futures on the respective index? Really good question. How does buying puts compare to shorting futures? So shorting futures is a very cost-effective, efficient way to hedge your portfolio. But the problem with a short futures contract or a short futures position is not only do you hedge the downside, you're also hedging the upside. So if you're wrong and the markets keep moving higher, you also do not participate on the markets moving higher. When you buy a put option, it's going to be more expensive. It's going to provide you protection to the downside, but it doesn't cap your portfolio's upside. And that's the primary difference. Why the difference between the comprehensive insurance and the portfolio loss? I'm not sure what you mean. I think, so it's because it's not a perfect hedge. It's what we call an imperfect hedge. It's not meant to give you dollar for dollar. When are you buying put insurance, Tony? Do you ever go out 3 to 4 months instead of 1 to 2 months? I personally do not go out 3 to 4 months. I'm lucky enough to have through recessions market downturns that have lasted very long. Most of the market downturns in terms of sheer volatility that I've seen have been very short dated. So my preference is to buy shorter dated options. And if I need to buy more options after they expire, I'm certainly willing to do so. But I usually don't go 3 to 4 months out just because they get really expensive. Wouldn't the volatility explode in a very aggressive down move in your example, increasing the value of puts? Yes, absolutely, Daniel. That is one other factor that I didn't factor into today, but for those of you that have some experience trading options, you also not only have to factor in the stock moving, you also have to factor into the fact that the volatility has changed. But remember, that only affects the value of the option prior to expiration. So that's something to also consider as well. I see the put spread strike prices moving on a daily basis. Do you adjust the put strike? No, Amita. So you're only adjusting the put strike prices when you're ready to exit the trade and re-enter the trade. You do not change your strike prices every single day. No. Can you comment on options on the VIX using greater volatility? I'm not sure what you mean by using greater volatility, but I can certainly comment on using options on the VIX. My issue with using options on the VIX is that if you expect the markets to decline from, let's say 480 on the S&P down to 420, what does that correlate to in terms of the VIX? The answer is you don't know, right? So how do you buy options on something where you don't really have a good sense for the target price? I can use previous levels on the S&P to draw target prices. That's how I buy my spreads on a hedge. But if I don't know how far the VIX will go on that move, it's harder. It's not impossible. It's harder for me to trade that. When to use VXX? VXX is just the ETF for the VIX. I'm personally not a fan of trading it. I know there's a lot of you that are. But I will be honest with you, I do not trade VXX options. Why don't you have SPX and OptionsPlay? Rosario, it actually just comes down to support of index options from the exchanges. And the exchanges charge a lot of money for display of certain index options like SPX. We work with NASDAQ. They've been working with us for a while, and they allow us to display their quotes for a very reasonable cost to you. SPX, unfortunately, is not willing to work with us. SIBO, that's why we don't carry VIX and SPX, just because of the tens of thousands of dollars they want to charge us just to display the quote to you. How do you know when to cash in on your insurance? So I think we've already discussed that, Dorothy, towards the end of my presentation. Using VIX is one way that you can do so. You mentioned XNB and its efficiency and cash settlement. Is there somewhere I can get more info on using these micro indices? Do you have an education video on this? Tommy, I actually do. If you go to our YouTube video, our YouTube channel, which is youtube.com/optionsplay, which I will post a link into the chat window. I have a video on index options, specifically on trading XND, the micro NASDAQ 100 index options. So I do have a specific video on that you can find, and I just posted a link into the chat window. How about using a collar? So Larry, that's what I was referring to at the end about selling calls and then buying puts with it. That is another way to do so. So you can just, instead of just buying a put option, you can also at the same time sell a higher call option against it. And especially if you own the stock, you can effectively 63 contracts. You effectively have a position that looks like this, and when you add a stock to it, you have a position that looks like that, which is similar to, let's say, buying a call spread. So yes, a collar is a very suitable strategy that allows you to lower the cost of buying a put option, but it also limits your upside. So if you sell calls like a collar strategy against the puts that you buy, you do cheapen the insurance, but you also cap the upside. What about using a calendar spread? So a calendar spread is similar. From my perspective, I don't think a calendar spread is really that suitable, because a calendar spread is a short volatility play, and buying protection is a long volatility play. So for that reason, I'm not a huge fan of using a calendar spread. You can, but I don't think it's the most efficient way to use options for this. Can we buy puts for SPY to cover the risk of general portfolio? Yes, absolutely. What momentum indicator do you use? Chatan, I like to use the commodity channel index. That's one of my favorite indicators. Is it worth to hedge a $25,000 portfolio? That's a question that only you can answer, because I don't know how much $25,000 means to you. If it's not a lot, perhaps you feel that you don't need to hedge that portfolio. If it's all of your wealth, maybe it is worth buying some protection. It's really that's a question that I unfortunately cannot answer for you. Yes, this presentation is recorded and posted so that you can view again. Would you recommend hedging stocks just before like PayPal or Facebook? So Linda, if you own those stocks, especially specifically if you own a sizable chunk of those stocks, and you're concerned that earnings will be poor coming up, you have two choices. You can either sell the stock or you can buy some put options. From my perspective, if you're holding on to those stocks for the long run, then yes, you could buy some short-term protection that protect yourself from an example like what we've seen here on Facebook. But I will say that if you do that every single time, you're probably not going to be very happy. If you do it only the times where you're fairly certain that the numbers are going to come out pretty terribly, then yes, I would say I think that it's worth doing. But I certainly would not do it on every earnings announcement. If you're heavy in one equity holding, does the same hedging logic apply? The same hedging logic applies. You would just use that equity to hedge with. So let's say you have 60%, 70% of your entire wealth tied up in Tesla stock. And I know some people that do, loyal Tesla stockholders, and they have hundreds of thousands or millions of dollars of Tesla stock. Then you would just simply buy put options on Tesla. So if you have single concentration in stock, buy puts on that one stock. Does the OptionsPlay platform only support mini index options? No, you have the full index options. You have NQX, which is 1/5 of the NASDAQ 100, and then you have NDX, which is the full NASDAQ 100, a $1.4 million contract. So all three are available here on OptionsPlay. Can you recommend an ETF in Canada for protection? So I would look at XIU, which is the S&P TSX 60. Would be my starting point. XFN, if let's say you have financial focused portfolios, a lot of Canadians do. There's also an ETF for oil and gas. I don't remember that off the top of my head, but I know that there is one. So if you have very, in Canada, you're either oil and gas, mining, or financials heavy, if you will. The TSX 60 is fairly concentrated in those three sectors, but if you have concentration in one of those sectors, pick one of the ETFs with that. Does VIX and market both go lower when market going down? Usually VIX is higher. Yes, usually VIX goes higher when the market goes down, but towards the market bottom, what you tend to see is the market declines and the VIX declines, and that's your clue that the market is actually near a bottom, is what I'm saying. If the VIX is still going up while the markets are going down, you're probably not near a bottom yet. I have in the money Google call options. What is the best way to manage these positions? I would say that in the money Google call options is similar to owning Google stock, and you could hedge that as well. It really just depends on how much longer you have until those. I mean, you have these February 12th, this expires next week. So I would not hedge, options next week. I would just simply sell the options that you own. When selling calls to offset put costs, do you prefer buying the back month put and selling the front month expiry call? That is one way that you can do it, Justin. That kind of maximizes the premium that you collect on the calls while minimizing the extrinsic value to buy that you pay for on the put option. So yes, that is one way that you can get a little bit more juice, if you will, out of the strategy. Only NDX and XND works, the app. There's also NQX, which is 1/5, so right in the middle. Is it a good time to sell puts on recommended stocks with 10% lower strike price and a premium of 10% dated 2 months? That depends on the stock, I would say. You certainly have a strategy, it sounds, right? You have a specific percentage out of the money. I personally will never sell a put option that's 10% out of the money. First of all, I never use a percentage. I use delta. You should always use a probability-based approach, not a percentage, because 10% for Tesla is different from 10% from Pepsi. So you don't want to just apply 10% across the board on all stocks. Different stocks have different volatilities. You want to adjust for that. Delta does that. In terms of 10% premium over 2 months, that sounds high. I don't know if you're going to be able to get 10% over 2 months if you're selling options that are that far out of the money. But you can usually collect about 2 to 3% over a 2-month period, selling about a 30-40 delta put option. That is the strategy that I use very often. Please clarify how you decide on the number of puts for varying sizes of portfolio. David, we have a calculator. If you simply put in the amount that your portfolio is worth, let's go back to QQQ, for example. Each share of QQQ is $353. If you use the risk and investment calculator, which is the third dot here at the bottom, all you have to do is type in your portfolio value. Let's say you have a $500,000 portfolio. You type that in, and it will calculate for you the number of contracts. You would need 14 contracts of put options on the QQQ to hedge a $500,000 portfolio. Is it okay to buy protection for individual stocks? Oh, I've already covered that. What delta strikes do you prefer when selling calls against the puts for a collar? You know, when you're selling calls against puts, that's really where you can get more aggressive. Normally, when we sell cover calls, we do a 10 to 15 delta. But if you're selling calls for a put hedge, you might want to get a little bit more aggressive, like about a 30 delta. Do you suggest buying put options if you have in-the-money call options that have time value left? You can. It really just depends on how much time value is left. I will be doing a webinar on technical analysis here in the next on February 17th with Rick. So we're really looking forward to hosting that here with you. Okay, that is the questions for today. Thank you so much for your time this afternoon. I hope that this was helpful in giving you a better understanding as to how to potentially protect your portfolio against further volatility here in the markets using options. With that, thank you so much. I hope you guys have a great trading day. I'll be sending out both the recording and the slides to you later tonight. Thank you so much and have a great night.